I don't care what you're investing in, whether it's stocks, real estate, or something else. Every time the tide goes out, every time a market turns, every time there's a 20% plus discount in the asset class, the natural psychology for all of us, myself included, I'm no exception, is to...
What is up, everybody, and welcome back to the Abundant Journey podcast. As always, I'm your host, Nick James, with Nick Offenkamp. We have a special guest, and why I say special is we got Travis Watts hanging out with us today. Some of you may recognize the name, both with his presence on social media, but on top of that, we've had the privilege of having him on about a year ago, and Travis and us, we recently connected and said, "Hey, Travis, let's get you back on the podcast. Let's get an update for what's going on in life." So, man, it's great to see you. How are you?
Hey, I'm doing really well. Thanks, Nix, for having me back.
Absolutely.
Dude, it's so good to have you back. It was so funny. It was a couple of weeks ago, Nick and I were on the phone and just talking about some of our favorite guests and who we'd love to have back on. And I kid you not, both of us were like, we really need to reach out to Travis. That was such a fun conversation. And it was as we were on the phone that you had sent Nick an email just checking in. And so we're like, oh, it's meant to be. We got to reconnect now. So I'm so glad that you've been able to make this work. And man, just I've revisited the episode that we did with you a number of times because there's just so much value and wisdom there. But for any listener that hasn't been able to go back and listen to it yet, or that started listening to the show since we had you on, maybe you could just do a little bit of an introduction to who you are, how you built your career, kind of what you're up to these days.
Sure. Yeah. It's, I'll take a different approach this time when I describe it, but I was pretty lost out of high school, didn't really know what direction I wanted to go. I was fortunate to have had an interest in kind of self-education from an early age. I had read a lot of the Kiyosaki books and things about real estate and passive income early on. It just wasn't applicable at the time, but it made sense to me. So I thought, okay, one day I'm going to get into real estate somehow. But I actually ended up going to college for live show production, audio, video, that kind of stuff. I wanted to tour with bands and whatnot. I got out there in the industry during the Great Recession when a lot of this stuff was belly flopped. And I thought, okay, this isn't a good time. Number one, I'm competing against everybody with more experience, and I just can't get my foot in the door. So I also recognized in '09 that real estate was on sale, right? It was a buy the dip opportunity. So I went out to Colorado, which is where I was raised, and I bought my first single family home. And I ended up getting a roommate first, kind of doing that house hacking strategy, having a roommate pay most of my bills. And then I turned that into a full-time rental. And then that kind of got the wheels turning as to, okay, if I have this much passive income right now, how do I scale that up? And like most people, it was a single family strategy for about 6.5 years. At least that's what I did. So I did vacation rentals. I had roommates. I had some buy and holds. I did some fix and flips. And inevitably, I was a W-2 employee at that time, working 14-hour days, 98-hour work weeks, away from home most of that time in the oil and gas industry. It was just too hard to scale a portfolio up that way. So I started attending live events, networking events, masterminds, real estate conferences, ran into a couple gentlemen who had sold their companies in the mid-1990s, much older gentlemen than me. And they revealed to me that they were full-time limited partners, and they invested in private equity and more specifically, multifamily syndications, which I had no idea what any of that stuff meant. It was all jargon to me at the time. I didn't know I could actually participate in large commercial real estate deals and be a hands-off investor. So I slowly but surely kind of crept my way into following their path, and so be it on a lower scale than what they were doing. And I, over about 2-3 years, became a full-time limited partner as well. I got rid of all my single-family homes, and I just really went after passive income investing that yielded tax advantages and equity upside as well. And so that all changed in 2015. And then in 2019, one of the groups I had been investing with pretty heavily was Joe Fairless's group, Ashcroft Capital. So I reached out to Joe to ask if I could come on board with their team so that I could get this message out to more people. Because as you know, this is not a heavily marketed sector when it comes to investing at large, right? It's all sucked up by the Wall Street firms and the brokerage houses and all that kind of stuff. So that's what I've been on a mission to do ever since 2019, is just do webinars and podcasts and in-person training and speaking on stage and just working with individual investors to showcase what private placements are, how you can actually be a passive income investor on a full-time basis, and how much more scalable that can be for many working professionals as I was. So today I'm Director of Investor Development at Ashcroft Capital, but also still a full-time limited partner as well in my own investing journey.
Amazing. Love it.
I love that as well. And, I hadn't asked you the last time what got you connected with Ashcroft. So I'm glad you shared that a little bit with us. I want to dive for a minute in a little bit deeper there. What made you want to jump in instead of just kind of going at it solo, doing your own thing? You really said, hey, I want to join a team. I want to try to make a dent in this industry where not a lot of people recognize they have an opportunity. Where's the passion for that instead of just saying, hey, I'm going to do my own thing and live my own life?
Yeah, I think that dates back, again, if we revert back to high school, I always had a knack for trying to help people with anything that had helped me. So I actually wrote a book in my senior year of high school, How to Get a 4.0 GPA with Minimal Effort, which is a terrible title, by the way. But I didn't do it for popularity. I didn't do it for money. I didn't do it to be a New York Times bestseller. I did it because there were things I was implementing that really helped me academically with teamwork and mentorship and different things. So I wanted to put that in like a little 60-page book and just literally give it out to different students that might benefit from it. So it started then. When I was fixing flipping homes, I wrote a book then to help people understand that, because a lot of people were asking me what I was doing, how I was doing it, if I could mentor them. It was just a more streamlined way of answering the question. And then I just launched Passive Investor Tips a few months ago, this year in 24, which is kind of the best of the, most liked, most shared, most commented on podcast episodes that I did with Joe Fairless under the Best Ever brand under his podcast, also called Passive Investor Tips. So I guess to answer your question, the underlying passion has just been, whether it's health or whether it's wealth or whether it's anything in my life, if there's something that I see is getting me ahead and really helping out, I don't just want to keep that to myself, just live my own life quietly, independently behind the scenes. I just want to share that with other people in almost every instance in a free way, so like I'm donating all the proceeds to the new book back to the Best Ever community, because that's just a side project I wanted to do. Now, where Ashcroft came into play was, I was an investor with them. Their deals were just meeting my criteria. Their transparency, communication was great. And I thought, okay, this is a brand I can associate myself with because I really believe in the product and the service. But what they were lacking is a full investor relations team and kind of the marketing side to the business. And it was Joe trying to handle everything as a general partner back then. And it just wasn't sustainable with the growth that they were experiencing. So I thought, yeah, I could do it on my own, but I'm not going to get the reach that perhaps their platform can provide. So it really became a win-win for the both of us.
Yeah, I mean, that's, in part why you've been such a great fit on the show, that abundance mindset of, not just trying to keep the pool as small as possible, but really trying to train up as many people, bring them into building passive income, real estate syndication, these things that, as you had shared your story, mentioned that historically have had a lot of gatekeepers around with the different Wall Street brokerages. So I think it's amazing what you've been able to build. I'd love to talk about just this last year, because so much of your experience in real estate, the projects that you've invested in have been value add kind of projects. And obviously the market has changed a lot in the
Yeah.
last couple of years. We're really feeling the effect of the high interest rates. Anybody who purchased properties on adjustable rate mortgages, those are coming due. Anyhow, since you're so in it, I would love for you to describe what you're seeing happening in the environment for real estate, as well as different pivots or adjustments that you're making.
Yeah, absolutely. To your point, it feels like everything's changed specifically over the last, 2 years since the Fed came in to raise rates. So we're in the midst of a capital market cycle. So it's not the same kind of market cycle that we experienced during the Great Recession, '08, '09, '10. Fundamentally, multifamily is booming, right? I mean, occupancy, collections, the need for affordable housing, all that kind of stuff is definitely intact. What's changed, to your point, is the debt structuring. In commercial real estate, it's common for short-term debt maturities, whether it's a bridge loan, 1 year, 2 year, 3 year, 5 year debt. So a lot of that debt's coming due from the folks who bought properties at peak pricing in 2021, early 2022. So you had all-time low rates, all-time high pricing, and now you might be looking at having to shift up a 3% loan to a 7% loan or something like it. So we're seeing a lot of distress, a lot of folks having to sell, unfortunately, because they can't afford to hold on to the properties. If they do, there may be no cash flow for years. It may result in a capital call. So I've been in the midst of all this with my portfolio, right? I've had pause distributions, capital calls, everything else. So, the important takeaway here is that while it's been kind of bad news for deals you bought specifically in, 18, 19, 20, 21, that kind of stuff, to a heck of an opportunity in 24 to get in. And I've always been an advocate for dollar cost averaging. A lot of people use that term in the stock world. You're going to buy a S&P index fund, right? And you're just going to put whatever 10,000 a year into this consistently or every single month or what have you. I do the same thing with real estate because I don't pretend to know how to time markets. I'm always wrong when I try to predict that stuff. So I'm investing as much this year, if not more, than I was the last year and the year prior. And I was an investor in 21, the same as I was in 2018, that kind of stuff. So as interest rates have come up, cap rates have come up as well. Now, when cap rates come up, with capitalization rate, which is different in every market nationwide, it hurts commercial valuations because the next buyer has to come in with higher interest rate debt, which is more expensive. So they're going to need a reduction in price to still cash flow and make the deal make sense. So that's kind of what we're in the midst of. I'll give you a practical example. We're closing on a Class A property, 2021 built property in Orlando, Florida right now. And we're buying it $97 million purchase price, 5.5% cap rate. If we go back to 2021, when this was first built, and assuming it was stabilized and cash flowing back then, it would have traded somewhere around a 3% cap rate, right? That valuation could have been 130 million, 140 million, just kind of depends. We don't know because it was vacant back then. But the point is, it also would have bought $97 million in 21 would have bought you like a 1985 Class B value add vintage, So it's an opportunity to buy these nicer, newer properties, or just even if you're in the Class B space, to dollar cost average and buy the dip. It's going to be very short-lived because you've already seen huge institutions jumping in with billions and billions of dollars, from Blackstone to JP Morgan to Jeff Bezos backing a real estate company, buying residential real estate nationwide. So something to think about, as the saying goes, the bull takes the stairs and the bear jumps out the window, meaning that a bear market is short-lived and it takes a long time to build up a bull market, usually about 8 to 10 years or so. So the second thing I'll say real quick is supply and demand dynamics, which is really real estate 101. So the National Multifamily Housing Council has suggested we need to build 4.3 million more apartment units between now and 2035 to keep up with the strong demand for multifamily housing. Meanwhile, if you look at new starts and new permits from developers, they're down 40, 50% nationwide on average, meaning they are not building at near the pace that they were in years prior. So we've got this strong demand, we've got discounted pricing, we've got new product that's not set to hit the market at near the pace that it was in the coming years. So where does that put you as an owner buying today? It puts you in a very good spot. This is very similar to buying the stock market when it was 25, 30% down back when. So opportunities we haven't seen in about 15 years. And keep in mind, it's the widest gap in U.S. history right now between a new mortgage payment and apartment rents. It's nearly $1,000 per month. And that's just the payment. We're not even talking about HOAs and property tax and insurance and maintenance and furnishing homes and repairs and rehab. It's very costly right now to be a homeowner, and it just puts more demand on rental housing nationwide.
I love that. I love the explanation, and I think it's super helpful to get a feel for where the market's at. I'm curious, with what I've researched with Ashcroft, you guys have really made a reputation and a living. I mean, Joe kind of wrote the book on value add investing. You're talking about how you're able to afford some of these nicer, newer places because they're at a discount. Are you guys feeling really strong still on value add? Do you like the new construction game kind of moving forward, or is it really just trying to find sweet deals?
Yeah, it's so this is our first A-class acquisition. So primarily what we've done as a company since inception is buy like a B minus, call it a 1980s, 1990s type of product, usually 50% or more value add potential to it, and then take it up to a B plus upon sale. And we usually sell to institutional buyers. So we're trying to get those institutional quality deals, which is not doing a lot of the C class, D class kind of product. So it's been a B plus kind of A minus strategy. Now with this new deal, it's going to be a very light value add. We're still going to enhance some of the units, amenities, of course, the marketing. We can add tech packages, which will boost the NOI. We can fence in the ground level yards, charge a premium. There's garages, there's parcel lockers. There's a lot of little things that we can do, but it's not your traditional value add. So this is another point, I'm glad you brought it up, of where things have changed. The name of the game in 2015 when I started doing this stuff in 16, 17, 18 was, hey, we just found a 350 unit apartment community and it's 100% older vintage. Every unit needs to be turned. You're just not seeing a lot of product like that because this sector got so popular that most of that older vintage has already been turned in recent years. It normally takes 2 to 3 years to turn around a community like that. So we're not seeing these 100% value add opportunities anymore. And as the markets have shifted, this deal just made sense because the current owners just simply can't afford to hold on to it because their debt's coming due. It's going to reset at, basically double what their rate was. And it just doesn't make sense for them logically. So we're able to scoop that up in this instance. But again, how many deals are going to be like this? I don't know. It might be one other, maybe two if we're lucky, but it's going to be very short-lived because the forward-looking forecast is for rates to come down and for cap rates to revert and begin compressing again, which puts a lot of buying demand and valuation boost onto the sector. So we'll see, but great question though.
Yeah. And does your strategy change then as you're looking at Class A property like that, where you mentioned with the Class B, B minus kind of stuff where you're doing a lot of value add and looking to sell that then to institutional investors? I mean, is that still kind of the exit plan with this Class A property, or is this something that you're looking at with this unique opportunity in the market where these are more buy and hold, something that you add to your portfolio and ideally cash flow on for years and years to come?
Yeah, good question. Relatively same business plan as we always execute on. So we're telling investors 5-year hold period. Historically, it's been more like a 3-year hold period, but we want to underpromise and overdeliver. Again, there's going to be light value add. So we're still going to go through what we're experts in. We're going to rebrand. We have a Halston brand. That's our trademark brand. So if any of your listeners are in Florida, Texas, Georgia, North Carolina, and you happen to see a Halston something or other, Halston Riverside, Halston Four Corners, that's our properties. So we
Cool.
have our own look and appeal to these, everything down from cabinetry, appliances,
Hmm.
backsplashes, our trademark scents and smells that you'll notice in the clubhouse and the model units, branded men's, branded golf carts. So anyway, it's relatively the same thing. It's just going to be a much lighter value add. And given the market forecast and the current market conditions, it's more of an equity upside kind of play as we hold about 5 years into the future, where valuations are projected to be much higher. So there is a cash flow component to it, though, as well. But it's A class, so less.
Well, the equity piece makes a lot of sense given what you're saying about the supply and demand dynamics as you look forward to the next few years and just the massive shortage of housing availability for the multifamily apartment space. So that's really awesome. As you talk about this being such a unique and incredible opportunity for folks to capitalize on, speak to the guy, the woman that's listening to this, and they're like, okay, I've got a few single family. I'm where Travis was 10 or so years ago, and I've got some single family properties, maybe some Airbnbs. I'm kind of tired of that. Would love to get into the passive world, but don't really know where at all to start. Thinking about this opportunity in particular, I mean, what do you recommend?
Yeah, it's a good question. So the first thing to realize, I think, for anyone getting started is that most limited partners, which is what I am full time, are not full-time limited partners. They're partial limited partners. So to your point, a lot of our investors have single family homes. They have Airbnbs, maybe they've done a flip or two, that kind of stuff, but they're using a syndication to scale their passive income, to scale up potential tax advantages and equity upside without having to allocate more time and attention to dealing with your own individual properties. Because as anybody knows, after you get to property 4, 5, 6, 7 in the single family space, or even duplex and small multifamily, if you're doing your own management, this becomes a full-time job. So not everybody wants that. There's a lot of doctors and dentists. They don't have time for that stuff. There's a lot of retirees. I'll take my dad, for example. He's got 7 or 8 single family homes that are rentals he's had forever. They're all paid off at this point. He loves them and they're in his local market and he enjoys the process as a retired individual. However, he's said to me numerous times, I don't ever want to have 15 or 16 rentals because then I can't live out, my retirement years the way I want. I can't travel the way I want. I can't do the things I want with my time. So this is just simply, for most people, a diversification type of investment. A lot of them still have the stocks and the bonds and the mutual funds and maybe an annuity and maybe some single family properties. This is just one other way to scale up your portfolio on a passive, with a passive approach, I should say.
Mm. Yeah, that's a great framing.
Yeah, super helpful. I want to stick with the topic of the investor because that's where you spend a lot of time with, thinking about the investors, thinking about the education side.
Yeah.
And also maybe putting on my banker hat. We love that word risk, and everybody wants to try to do their best to mitigate risk. One of the things we had talked about was really diving into that. There's so much noise out there in the market. There's so much fear. There's so much, commercial real estate's going to blow up. You're going to lose all your money. What do you say to people like that? And maybe what's the sentiment that you're getting from investors with the market today? Because I know you guys are optimistic, excited. What are some things you guys are saying or encouraged about to be able to speak to that?
Sure. Let's get totally transparent with it because this happens every time. I don't care what you're investing in, whether it's stocks, real estate, or something else. Every time the tide goes out, every time a market turns, every time there's a 20% plus discount in the asset class, the natural psychology for all of us, myself included, I'm no exception, is to remain on the sidelines, take a pause, don't do any new deals, look for the exits, this kind of stuff, right? You can see that data over and over and over. I used to work for one of the largest brokerage houses in America, And, I remember I was fascinated with the data of '08, 9, 10, how many people sold right at the bottom just because they
Mm.
could, because in stocks you have total liquidity in most cases. So we're seeing it now. We've seen this play out over the last 2 years. Virtually all headlines are intended to be somewhat of clickbait. So fear gets attention. The more views and clicks they get, the more money and revenue they make, the more ads they can sell. This kind of stuff. So it doesn't make sense to say, multifamily's not really budging right now. It might go up, it might go down. We don't know. That's not going to get clicks, right? But to say the sky is falling and it's all just hell breaking loose, well, that's going to get some clicks. But if you really read between the lines, something I started doing over the last 2 years to kind of tackle this hurdle is doing a quarterly multifamily market insights report, completely free at ashcroftcapital.com. I'm writing these, and what I do is I take data sources from multiple, as many as I can possibly get, national reputable firms. So U.S. Census Bureau, CoStar, CBRE, Marcus and Millichap, Urban Land Institute, etc. And I'm saying, look, here's what this group says. Here's what this group says. Here's what this group says. Here's the current data. Here's the past data. Here's the forecasted data. This is where we're at. You can read between the lines. You can figure this out. But there really isn't a lot of good resources like that can, especially for free, that can just help you make your own decision, right? So that you're not scaling Google headlines and things and trying to figure this out for yourself. So the bottom line is, again, we're in a market cycle. We're nearing the bottom if we haven't bottomed already. We're speaking here in the summer of 2024. And we've seen a tremendous new supply hit the market. We've seen vacancies increase. The interest rates have been held for nearly a year at the top of this rate hike cycle. We're near the bottom, and now these institutions are scooping up the deals and jumping in with billions of dollars. And again, the forecast is for rates to come down, which helps bolster valuations moving forward. So I would say this. I would say check in with your psychology. Again, dollar cost averaging, buying the dip. When prices come down, risk comes down. When prices go up, risk goes up. Those are a few things to keep in mind, as we find ourselves here in the summer of 24.
Yeah. And that report sounds awesome. That's definitely something, listeners, you can find a link to that in the show notes. We'll be sure to add that in because it does seem like that's one of the greatest challenges right now is just finding good, thoughtful information to make sense of the market and to get away from all of the noise and headlines. So I'm really grateful that you put that together. Curious, when we talk about the psychology of an investor, what are some of the resources, books, mentors that have spoken into that for you? And how have you trained yourself, your mind, your emotions to stay strong as you've seen these different market cycles? I mean, I imagine that's a skill that's taken time to cultivate and even something that you got to return to as you see the situation change over and over again.
I think it's a great question. And, I think it's just a unique perspective, having worked with literally just thousands and thousands and thousands of investors over the years, starting with the brokerage house into a small startup syndicator into Ashcroft, doing multiple roles with the company. I do so many events. I speak with so many people. So I kind of have like a weird upper hand advantage in that respect. Sure. But, and not to mention the, just hundreds of books that I've read over time and self-help and, like Joe's book and all these other books and all the podcasts that I listen to and stuff like that. So you just kind of read between the lines at a certain point. And it's funny because you ask almost any investor, I don't care what they're investing in, you ask any serious professional investor, are you short-term or long-term as an investor? Almost everybody says I'm a long-term investor. But when the market shifts, turns out they're looking for the exits or they're on the sidelines, so they're short-term thinking. So it's a skill set to be able to zoom out to the macro, which is what I try to do in these reports, but then also zoom in to the micro and actually take action and do small steps moving forward. So it's just a practice. It just takes time. there, obviously your podcast is amazing. The Best Ever podcast is amazing. We put out tons of educational resources at ashcroftcapital.com. There's a lot of good material out there. But again, with that market report, I try to just take the commentary down to a bare minimum. It's not about my opinion or some bias. It's just about, here's a bunch of data and here's a quick explanation of what it is and how and why that's important.
To that, one of the things I love about your journey is that from an early age, you recognized, hey, I want to get in the game, and you've continued the education. As we talk, education is so important in your journey, and not only from one, you gobble up as much of it as you can, but on top of that, you're trying to give back on the education side, and that's what so much of your effort is. What do you say to the newer investor? What do you say to somebody who is on the sidelines, who there's this balance between, well, don't jump in and blow yourself up because you don't know what you're doing. But two, we also know the people who are on the sideline and they've been for years and years. You seem to have struck that balance.
Yeah. So here's a fun story for you. It was like 2013, 14, somewhere back then. I set this really ambitious book reading goal for myself. I said, I'm going to read a book a week this year. This was like my New Year's resolution, which is 52 books. I'm going to read them all. And I did it. I actually did it by December. I read 52, most of them, almost 90% of them, self-help, self-education kind of stuff. I don't recommend it. It's too much. It's way too much, right? I probably only retain 5 to 10% of what I read, from back then. So where I found the balance was, you need to, let's say, read one book or do one conference or have an hour-long conversation with one mentor or a couple, and then take a small step forward. You got to take a little bit of action. I mean, that's the balance for me. That's worked really, really well. You need to know, I forget, there's an actual scientific study on this, but if you can know, let's say 70% of what you basically need to know on something, take a baby step forward. This doesn't have to mean go all in, or do huge things or put all your money into one basket. Just take one baby step. And then educate yourself again, revert back to, okay, I want to go to level 2 now. I want to learn a little more. I want to be a little bit more of an expert on this. And then you're up at 80, 85% of everything that you could possibly need to know. Take another baby step, and if it's going well and you're getting results and all this kind of stuff, go back to the education, go to a level 3, So that's kind of how I approach things in any regard to life. I'm going through it right now with health and diet and fitness. I'm an amateur, I've put so much emphasis on other things. And so now I'm finally just understanding the basics of just like macronutrients, and my BMI and all this kind of stuff, and setting up like I'm at a level 1. And then, but I'm implementing, I'm working out every single day. I'm trying new diet things. I'm running a calorie deficit right now. And then once I see a little result out of that and I say, okay, something's working here, I'm going to go back and study more. I'm going to become a level 2, and then I'm going to fine tune it. And then I'm going to move forward again and make some tweaks to the strategy.
I love that you make that point, because I do think that knowledge can be a lot like our physical diets. I mean, food is a great thing, but food is supposed to be fuel for the body to go out and do stuff. And if you're eating all the time but never actually acting upon it, you get fat, and it makes activity even harder. And I think that we live in such an information-rich age that it's easy to sit behind a screen and just absorb information. But if you don't take action with that information, like what you're saying, you kind of get mentally fat, and it makes it actually harder to go out and do something, because it can seem so overwhelming with all of the different information that you have and trying to put it all together. So I think that's a really helpful point. I'm curious too, just obviously you kind of started to speak to, having a breadth to the things that you're reading, your interests. You've spent a ton of time in the real estate space, but when it comes to self-education, reading. I mean, how do you pick what it is that you want to read about? How do you find a good book? I mean, this is, we're shifting a bit away from the nuts and bolts of real estate, but
Sure.
I do think that's a real question for a lot of people of just, do you take a more generalist approach and see that, like, okay, if I just follow my interests, that's going to ultimately help me in my business and career, real estate investing? Or do you really feel like, no, I need to be reading a certain amount of real estate books every year, listening to a certain amount of real estate content?
I would say first and foremost, our time is extremely valuable. And I'll tell you some mistakes I made and that I see a lot of people make when it comes to, let's say, reading. Let's start there with books. First thing is experiment. So try different styles of books. Try an Audible or an audio book. Try a physical paper book. Try an e-reader. Okay. And just see what resonates with you. I don't always have the time to sit down with a physical book and read for an hour or two every day. So I use audiobooks when I'm working out or when I'm on a plane or when I'm, driving or whatever. So that's the first thing. The second thing I've learned is that, there's millions of books out there. Not all of them are great. Okay. So if you get into chapter 3 and you're like, I'm not feeling this, I'm not getting anything out of this, quit reading it. It's okay. Like, you don't have to finish a book beginning to end. So many people get stuck in that, like, well, I'm halfway done with this book. I hope I finish it over the next couple. Don't finish it. Just don't. And the third thing is you can actually speed read. And I don't mean just reading really fast on a page. I mean, first of all, doing a little research on the book before you even get it. Is it really something you're interested in and that you think could be valuable? Just start there, number one. Don't get random books from wherever. 2, just read through the table of contents. If there's chapters that have no relevancy to you, skip them. Especially with self-help books. It's not a story. You can skip pieces and parts. So I usually look at the table of contents, skip over all the forewords and stuff like that. I'll read maybe the jacket cover in the back or something. I'll read chapter 3. I'll read chapter 6. I'll read chapter 9. I'll skip around and then I'll read kind of the conclusion, because most book deals are put together where, and this is something I did not do with my book intentionally, but if you go get a publishing deal, they're going to want 200, 300, 400, 500 pages. Well, the fact of the matter is there's usually 5 or 6 valuable nuggets in that book, and you got to go through 500 pages to find them. So just try to shift through them. They're usually in the front and the back, the jacket cover, the back, and again, scroll the table of contents. There's some books you can literally get through in maybe an hour to 2 hours, and you're going to get all the valuable info that you actually need out of that book. So just think about that as well.
Yeah, that's great.
That has to have been nuggets of wisdom you would tell your younger self when you were going through those 52 books in 52 weeks.
Yeah, I actually adopted it during that time because, again, some of these books, I was just like, man, I'm 150 pages in and I'm not getting anything out of this. And so I would start to kind of speed read it, and flip through. So I'm not saying literally I read word for word, 500 page books times 52. I took notes, and so I would take like literally handwritten notes. I put it in the jacket cover of each book so that if 6 months rolled by and I'm like, what exactly was that book, trying to say? What were the key points? I just go back and reference my notes real quick and say, yes, it was that. And that just made it a lot more practical for future use because, and again, it's scientifically proven. It's something like we retain 10% of what we read over time. So just keep that in mind, so if you can bullet point out the practical stuff, it'll really help you out.
Yeah, totally. We've talked a little bit about the person getting started in investing. We've talked about the experienced person, and how are they feeling about the market? Let's talk for a few minutes about the middle person. I'm wondering, your time when you had the single family homes and then you said, hey, I'm ready to jump into larger things. I'm ready to jump in and be a passive partner. I'm curious, maybe on 2 fronts. One, we have talked a little bit off camera about vertical integration and maybe some ways to automate and systematize the process to make life easier, but also maybe the person who's just saying, hey, I just want to hand the reins over to somebody else who is doing it full time like you guys are. What would you coach them on, or maybe some wisdom you'd give to those folks?
Yeah, I think that the first thing to realize is that, I naively went about single family thinking about passive income as the end goal, thinking, yeah. I'm gonna start with one property, then I'm gonna have 10, then I'll have 50, then I'll have 100. One day I'm gonna retire, I'm gonna have this huge portfolio of single family homes, and I'm just gonna kick back and do whatever I want. The reality is, you still have to find these deals, underwrite these deals, show up to closings, do a lot of paperwork, hire teams, change out teams over time, still make active decisions, right? Like, do you want to repair the roof? Do you want to replace the roof? Which contracting company do you want to use? There's still a lot of active components, even with property managers and teams in place. So that's the first thing to recognize. With a syndication, to your point, and we'll talk a little bit about vertical integration. A general partner is finding the deals, underwriting the deals, doing the due diligence, running all the numbers, raising the capital, putting together your tax forms, putting together reporting. They're doing everything on your behalf. It's a front-loaded business model for a limited partner such as myself, meaning I have to look at the deals, I have to do my own analysis, and I have to decide if I'm going to invest, and then I have to sign some paperwork, send in my funds, and then boom, it's done. From that point forward, it's either monthly reporting and monthly distributions, or it's quarterly, whatever it may be. But it's really hands off. And I can tell you from firsthand experience, bar none, it's so much easier to have 50 or 100 limited partnership investments than 50 to 100 single family homes or duplexes or small multifamily, anything that you individually own. So that's the first thing. Again, to the person kind of in the middle, I think a lot of that already, being that type of individual. But again, educate yourself to a point where you feel comfortable potentially making a small investment. Maybe you're just going to do a minimum investment in one syndication and try it out. That's exactly what I did, because I'm first to admit, I was skeptical when I heard about syndications. I'm looking at these projections and pro formas and I'm going, whoa. You're telling me I could make basically the same return without doing any of the work that I'm currently doing? No way.
What's the catch, right?
Yeah, exactly. I was skeptical, but having those mentors really helped, because they had done probably 200 plus limited partnerships at the time where I was speaking with them. And they talked to me about 08, 09, 10. And, we went through it all. And I had a certain level of comfort after that, but that's all the self-education component. Most of that coming from mentorship, some of that coming from books and podcasts and other sources. So I did one deal with the minimum investment. I'm like, I'm going to pump the brakes here. I'm going to wait about 6 months approximately. I'm going to make sure this is real, that there is transparency, that there is open communication, that I'm actually going to get distributions. And then once I saw this working out, I thought, okay, this is a far better platform to use than trying to go about it the way I've been going about it by myself.
Yeah. Maybe we can talk some about just the uniqueness of Ashcroft Capital, both what drew you to them as a passive investor, and then now that you've been working so closely with them for a number of years now, what some of the unique value proposition is for Ashcroft as a group to invest with. And maybe you can contrast that for listeners that are skeptical with, what are the things that you do want to watch out for? Because certainly not every syndication experience has been a good one for folks. And so I'm sure that there was some due diligence and vetting that you did. So I'd love to just kind of hear both the positive sides of Ashcroft, why that's been such a good fit, why listeners should consider that, what they should watch out for.
Yeah, I would start with this, and this is what I tell everybody. You got to start with yourself. What are your goals? What are you trying to accomplish? Again, so it really starts with self-education, right? Just to know this stuff exists and what it is and what some of the terminology is. By the way, I have a YouTube segment under Ashcroft Capital's YouTube. It's called Multifamily Investing 101. And it's all the industry terminology. If you're just getting started, you might start there. They're like little 2-minute clips of just what's a cap rate and what is IRR, and what are the fees involved in a syndication. So it walks you through a lot of the first steps. Okay. Second thing I would say, back to your question. So I started with me. What am I looking for? I was always doing Class B value add. I call it Class B with single family. It's not necessarily a thing, but I mean, it was older pre-existing properties. My first property was like a 1985 property that was in almost original condition by the time I bought it in 2009. So I bought it, 30-40% off given the market conditions. I went in and I did most of the rehab myself. It was nothing major. It was like a 900 square foot home, it was tiny house. And then getting the roommate, and there was a government tax credit and all these things going on. I made it its highest and best potential, and then I sold it. And this is something I refer to as the velocity of capital, and something that really turned me on to what Ashcroft was doing when I finally learned about syndications. They were also doing Class B value add and then selling once that property hit its highest and best potential. There's pros and cons to holding a property technically forever, right? Which a lot of people do. It's like, I'm going to buy these homes, and then in 30 years, my tenants are going to pay them off for me, and I'm going to have these free and clear things. I ran the analysis so many times, and specifically, I'll use the example of that home I'm talking about in Colorado in '09. I bought it for it was like $95,000. Okay. Today it's worth about $250,000. So my first thought when I ran that research, because I hadn't looked at that home in forever, and I was like, wow, I should have just kept it. 95, $250, what a heck of a deal. And I could have rented it the whole time. But instead, what I did is I sold it after about 3 years. And then I went into another value add deal. I fixed it up and I sold it at its highest and best. And then I flipped it into another deal. And then I did another value add and I flipped that. And long story short, 15-year period just with that one strategy, which is not my whole portfolio. It's just that value add strategy, which is my favorite. It turned into about $1.8 million as a return that started with $40,000 cash. That's all I had when I started. So 1.8 versus what? 150,000 return. You know what I'm saying? So the velocity of capital is something I really love, and it's something that Ashcroft does with these 3 to 5 year turnarounds on average. So you can 1031 exchange as long as that remains in the tax code. You can help offset taxes that way. But when I put 100,000 into a deal and it becomes 2, I usually don't 1031 myself. I take the money, I pay my applicable tax, and then I diversify and I do 2 deals. And then those 2 deals come to, maybe doubling over time. And then I do 3 or 4 deals, and I keep diversifying and snowballing the portfolio that way. So that's kind of the starter to your question. The second thing I'll mention is the vertical integration. Ashcroft Capital waited till they hit scale to go vertically integrated. And vertically integrated means, at bare minimum, it means that you manage your own properties in-house. For us, we manage our own properties in-house, we manage our own construction management in-house, and we have our own trademark procurement process, which we'll talk about in a minute, to save about 30% and just make a lot more efficiencies out of our portfolio. So we were facing challenges. Quite frankly, we were outgrowing the third parties that we were using. Okay, we were comprising 40% of the property manager's portfolio before we went vertically integrated. So we were just moving fast. Wow. They didn't have the adequate infrastructure. We had no control over who they were hiring or putting on our properties. There was just lack of alignment of interest, lack of talent, insufficient infrastructure for our growing needs. So we were over $1 billion under management at that point, and we decided we're bringing this in-house. We're going to start from hiring at the top with management level, and we're going to trickle down from there. We're going to train them up for about a year, and then we're going to launch. And so that's what we did with Birchstone Residential and Birchstone Construction. And we're very management heavy because we care a lot about attention to detail and about training and about culture. And so after doing this, we've there's a lot of things, increased culture. The KPIs have increased from collections to vacancy. There's just a lot more accountability across the board. And the last thing I'll end with here on vertical integration is our procurement process. So during the supply chain disruption, during the ramping up of inflation that we started to see 21, 22, we came up with something called Sure Home, which is our trademark procurement process, where we order direct from manufacturers overseas. We get custom made product for our properties that are unique in the marketplace. No one else has them. We save about 30% compared to contractor discounts at local hardware stores. We have them shipped to Dallas, where we have warehouses, and we assemble these little ready-to-use kits for renovations. And then we ship a crate right on site to a property that we just closed. Usually goes to the backside in the parking lot. And our team's on site, they open it up and they got enough inventory there to start turning about 20 to 50 units on average. We're talking about door handles and shower rods and cabinet pulls and ceiling fans and light fixtures, all this kind of stuff, not countertops, flooring, and appliances, not the big bulky stuff. We source that locally. So, it's brought our turnaround time to 14 to 21 days on average, which saves investors. Time is money in this business. And then it's environmentally friendly. You think about going to a local hardware store and saying, I need 1,000 shower rods, where you're going to get this huge packaging with styrofoam and plastic and colored cardboard and all this markup. And it's very inefficient. It's very much not environmentally friendly. So when we have shower rods ordered, it's like a pack of 1,000 without the plastic or styrofoam in a box shipped right to us, right? So it's just a streamlined process that we've created. And I'll give you a practical example of how this value really adds up aside from a 30% savings. We have a custom made flush mount light that we put in almost every unit that we have. And by the way, we've acquired over 21,000 units. So just think about this math real quick. So these flush mount lights have one bulb instead of two, because it's common in those to have two, right? And plus they're LED, so they're eco-friendly. And we don't just save the money and have a unique product and it's energy efficient, but if somebody breaks that light by mistake, let's say someone installing it or a resident, well, what would you do in most normal cases? You'd have to run to a local hardware store, buy another light. It's going to be 30, 40 bucks, whatever it is, and you're going to replace it. We have it down to just the parts and components on stock at the property level, such as the glass inserts for the light. So if the glass gets broken, we just slide a little 50-cent replacement piece of glass in there that's made for those lights, and then we don't have to replace the entire fixture. So you think about saving $10, $20, $30, $50 times 21,000 units on top of the 30% savings. It's huge. It's right. Literally millions and millions of savings every year that flows through to our investors. So these are some of the advantages. If anyone's listening from a GP level, something to think about with vertical integration and supply chain stuff. But as an LP, to recognize that's value that is being presented to you that's unique in the marketplace that most people aren't doing.
It's awesome. I love getting geeky about that kind of stuff as far as just maximizing efficiencies. And I'm so glad that y'all have been able to figure that out and continue to push the envelope forward.
Yeah, it's been impressive. I got a tour of the headquarters down there and this whole supply chain thing that we got. It's like a little mini Amazon is kind of how I see it. You know, it's like our little in-house Amazon system, but it's really cool.
That's awesome.
Awesome.
I love it. Well, Travis, this has been absolutely fantastic. As always, we knew we needed you on for multiple reasons, but I don't think we can end our episode without another round of gold nugget questions. Last time we asked you a handful, and of course, I'm throwing some different ones at you since we don't want to repeat. Yeah. That sound good to you?
Sounds good. Let's do it. Yeah.
All right. So as always, I'll fire these at you. We got 4 questions. This one I've been curious about for you because you're in the education space. What is bad advice that you constantly are hearing out there? And what would you say to it?
Wait and see. Here's a quick story. I'll be brief. 2016, I reach out to a general partner that's very well known in the space. I didn't know many general partners at large. I'm like, please put me on your list. I want to do a deal with you guys potentially, yada, yada. He says, we're probably not doing any deals right now because 2016 is looking like possibly the biggest down cycle that we've ever seen in U.S. history. So we're not buyers right now. We're looking to sell and do nothing. This guy was on the sidelines till about 2020 or 21, doing virtually no transactions. In the meantime, I took a different approach and thought, dollar cost average, it's really hard to time markets. I nearly doubled my portfolio over that same time frame. So it's just, you've already got the data in place to show you the discounts that are happening and what's already happened. Just look at the data and just think about dollar cost average, think about buy the dip, think about lower risk with lower pricing. And yeah, don't be persuaded by just clickbait or scary headlines or other people's strong convictions. Read between the lines, listen to both cases, a bear and a bull, and just kind of make a decision from there.
I love that. So much of everything we talk about, whether it is fitness, family, all of those things, or the finances and the investing, it comes back to taking action. And I think, like you're saying, somebody standing on the sidelines versus jumping in the game and taking action, they're going to end up in completely different spots. Next one here, why is an abundance mindset important versus scarcity mindset? And we've talked about that in the past in your own life. I'm curious if you would tackle that question from being around giant institutions. There seems to be that dog eat dog, gobble everybody up mindset. Why are you, you even said, hey, I want to spread this information and education to other people to better their lives. Why is abundance versus scarcity mindset so important?
Yeah, it's a great question. Again, I think the more you study, the more you look at the facts and the reality, such as, I'll go back to that Blackstone example, because you mentioned institutions buying up. I don't even know the number, but I know in one instance this year, it was like 38,000 units in a single acquisition. We as a company, over all the years we've been a company, have acquired 21,000. So they just effectively did more than double in one hit. There's so many deals out there. There's just billions and trillions of dollars out there. And so what I used to think of as a syndication being, we're playing in the big dogs now, we're going to buy a $50 million apartment complex. That's nothing, man. That's pennies. That's just such pennies. So you just have to realize that that's true about money at large in general. There's just, you might think individually, I make 200,000 a year. I'm doing really good. That's the highest income of my family. It's nothing, man. There's people making 20 million a month, So it's just looking at some of those facts and data and just being okay with that. Just saying, there's a lot to go around and, we're playing a small role here, but it is important that everybody has a chance to participate in this stuff.
It's good. That's good. Next one here. Are you a journey or a destination person? And how has that impacted where you are today?
Funny question. I love that question, by the way. I was a destination-driven guy from an early age up until a point. And I think that point was when our son was born in 21. And again, so many things have changed, obviously, from, becoming a parent and all those kinds of things. But with the health stuff too, I really started to kind of zoom out and go, wait a second. It's not all about just this goal, or X amount of net worth, X amount of passive income. That's not really what the goal is. It's about what are you doing with it? What's the whole purpose? No one wants to die with $10 billion in the bank. There's no point. There's literally no point. So I started looking at life a little more holistically and being in shape and longevity and energy levels, being able to be there for our son, being present with him. That's something I've struggled with a long time early on. I was never present. I was always just sitting there in the moment thinking about tomorrow, next week, next month, next vacation. And so I'm a journey guy now, for sure. I'm a journey guy.
Love that. It's a great answer. And I think it's awesome that you've been able to reflect on that. I think as entrepreneurs, as investors, we get so focused on next, future, that we forget to stop and enjoy the moment, because that's what we really do have. So I love that. Last one here. The question is, what is the advice you'd give to your younger self? That's very broad. So to narrow it a little bit here, I know you've done what, close to 50 deals as an LP passive, or maybe even more than that. Speak to that question with that in mind. The newer investor, somebody looking to jump in as an LP, what advice would you give to them?
Yeah, I would say that, two things quickly. One is to always remember to diversify. There were some deals I did early on in private equity, two of which were not real estate related, but they were private investments. And the projected returns seemed to be, well outpacing what I could do in real estate, 20% cash on cash returns, et cetera. I went really, really, really heavy on investing in those, and one turned out to be a Ponzi scheme, and the other one stopped distributions. So basically, the two largest investments I made early on were the worst investments that I made in general. So I would have backed up to say, I'm going to do something like, and this would be different for everyone, but like 50K or 100K tranches on every deal. Even if I thought this deal is going to be amazing, I would still taper that down. And some of that advice, by the way, unfortunately came later from one of my mentors. This guy had, I don't know, $80 to $100 million net worth. And he said, I never put more than 100,000 into any private equity deal. And I thought, that's crazy, man. That must be a logistical accounting nightmare. But then I went through that experience and I thought, okay, it kind of makes sense.
Some nightmares are worth it. Yeah.
At any given point, you could look at my portfolio and see underperforming deals, outperforming deals, and the majority of the deals somewhere in the middle. The point is, had I known they were going to underperform, I never would have done them. And so the point is, you can't know. So you got to diversify. Yeah. And number two, banking on solely appreciation is not a great long-term strategy. It's what I used to do when I flipped homes. And then when I suddenly realized how much the market had been helping me, I realized I really wasn't that good. And if the market turned on me, I'd be losing money. And it was kind of that epiphany that I'm like, I need to focus more on cash flow and passive income and sustainable strategies that can withstand market cycle shifts. And just like with the fixed rate debt that I'm in on these syndications, none of those deals have stopped distributions. The only downfall could be that we're going to wait a few extra years to sell the deal. But meanwhile, we're still cash flowing the same as we ever were, and it's actually growing. But the floating rate deals, a lot of, pause distros and capital calls and different things coming up. So again, you can diversify in multifamily and self-storage and mobile home parks and car washes and land and notes and hospitality and industrial. There's so many things, and with different business plans and different debt structures. So again, just try it out. If you're curious, do a little 25K investment or something if that's possible for you, and just see how it goes, and you'll learn along the way.
Yeah. Man, there's so much gold here for us, for our listeners. Travis, super grateful for just your time and engagement. I'm going to have several links in the show notes to the YouTube channel, the report, podcasts. I mean, you have no shortage of content, but still, what is the best place for our listeners to connect with you? Where's the number one spot you'd send them if they're just going to go to one place?
Yeah, I put most of that in one landing page, and you can find it at ashcroftcapital.com/Travis. I've got my calendar on there. I'm always happy to do 15-minute calls with anybody and everybody for any reason, anything you want to take a deeper dive on. We've got current offerings, opportunities, financial trackers. You can find the market insights report on there. So most of it's there. Instagram and Facebook is at Passive Investor Tips, and Travis Watts on other platforms. And also the name of the book is Passive Investor Tips on Amazon.
Solid. Man, it is so good to catch up with you. I'm really glad that you're finding ways to thrive and make it, even in a challenging market, rolling with the punches. And I'm also grateful that you're continuing to educate others so that they can find a way forward in these new times as well. So we wish you all the best, man, and can't wait to catch up again soon.
Thank you. Thanks, Nick.
Thanks, everybody.
Absolutely.